The last session to take us to lunch will be led by the Executive Director at the, Executive Secretary at Community for Affordable Housing, and Kmrc. Please feel free to take your seat up there. Thanks.
Thank you. I'm sure everybody's very hungry, and we're going to stand with one more session between you and lunch. Lovely to see you all, and thank you so much for coming in person to this 37th annual conference of the African Union for Housing Finance. We're delighted to have all of you here. We've moved the agenda around a little bit to manage some of the time. And I need to confess to my panelists that our time is going to be shortened as well, so we need to be precise in our discussion. A key issue of interest and concern within Rwanda, and we've already heard it in the questions this morning, is the financing and the end user financing. Affordable mortgages that then create the opportunity for offtake so that developers can build affordable housing. And Rwanda has a Rwanda Housing Finance Program, which we will hear about after lunch. And part of that is the consideration of whether or not Rwanda would benefit from a mortgage liquidity facility, similar to what exists in other countries. So understanding that, we organized to pull together a panel of the mortgage refinance companies in the neighborhood. 3 of my panelists are also board members of the African Union for Housing Finance. And in this session, we're going to talk about the experience of mortgage refinance companies and the impact that they have on their local economies in Tanzania, in Nigeria, in Kenya, and in West Africa. So if I can please invite my panelists to the stage. Kehinde Ogundimu from the Nigeria Mortgage Refinance Company, and also the treasurer of the African Union for Housing Finance. Oscar Mgaya from the Tanzania Mortgage Refinance Company, a past chairman of the AUHF and a current board member. And Johnston Oltetia from the Kenya Mortgage Refinance Company. And then our 4th panelist is Christian Agosa from the CRRH, which is the West African Mortgage Refinance Company. Have we been able to get Christian on the line? Okay, so we'll start, and perhaps the conference organizers can just let us know when Christian arrives. He has been on standby this morning. He is in Togo, and he'll be calling in from there. So this is an excellent opportunity to have this conversation. And I know that there's a lot of interest within Rwanda about how mortgage refinance companies operate, the history behind each of your initiatives, and what you're doing in your particular contexts. And so, as a first question to each of you, if you could please just describe a little bit your origin story. Why you were created as an organization, what was the goal behind that, what are the key performance indicators that you're trying to achieve? Just a little bit of that background. Kehinde, we can start with you.
Thank you, Kisa. I'll start with Nigeria. The Nigeria Mortgage Refinance Company was created specifically to solve a few problems that we have in the housing finance sector in Nigeria. The first challenge we had was the funding mismatch. So all our commercial banks had short-term deposits, but they could not create long-term assets because of that mismatch. You have 3 months money, 6 months money, or maximum a year's money. And then for you to now create risk assets like mortgages for 5, 10, 20, 30 years was impossible. So we had that huge mismatch. So one of our primary responsibility was to cover that gap. And we do this by intermediating between the financial markets and the debt capital market. So before we came on board, the mortgage you could get in Nigeria was maybe 5 years maximum, or 7 years, or 10 years. But we have been able to tap the debt capital market, and we have done that on 3 occasions, where every time we go to the market, our bonds are oversubscribed by at least 300% because of the appetite. We have a rich debt capital market in Nigeria. So we have been able to now, because of our intervention, increase the tenor of mortgages in Nigeria up to 25, 30 years, for as long as you can, because affordability is a function of so many things, the income, the price of the houses, and also the tenor. So we have been able to address that angle of funding. So in Nigeria now, nobody can say that they don't have access to long-term funding. It is now at what cost? So we have solved the availability of liquidity. It's now the pricing. And because we also have the government guarantee, we issue at the debt capital market at what the Nigerian government issues, plus about 50 or 70 basis points. So we are really competitive in terms of our cost of funding, and then we on-lend that to the banks who on-lend to mortgagors. So we've been able to address that issue of maturity mismatch in the sector. But much more fundamental is the fact that for mortgages to thrive in any economy, the legal framework must be sound. In Nigeria, we have what is called the Land Use Act, which vests the authority of land with state governors. So Nigeria has about 36 states, like the US, 50 states, maybe you call them provinces here. And in Nigeria, these governors have to physically assent to every land transaction. And you know what that takes, they are busy with some other things and all of that. So at Nmrc, we realized that we had to also solve that problem. So we came up with what is called the Model Mortgage and Foreclosure Law to address that legal loophole, or the lacuna as they call it in Nigeria, of making sure that you're able to get your titles timely at a reasonable rate, and then transfers are done properly. We decided to, because as I said, we have 36 states, and that means you have to go to every state. It's not something that can be done at the national level. It has to be done at the state level because of our constitution that vests it at the state level. We have been able to get the major states in Nigeria, starting with Lagos State, which accounts for about 40% of our GDP, to sign on to that. We have done with other states, and many more states are coming on board. So that's in addition to the first thing I said on the maturity mismatch. So we are solving the legal framework. Thirdly, we also look at origination. We play in the secondary market, so there must be a primary market that is thriving. For you to have an efficient secondary mortgage market, we want a standardized or industrialized or commoditization of mortgages. So we came up with what is called uniform underwriting standards, where all banks in Nigeria, irrespective of the bank, follow certain criteria for profiling, evaluation, and originating mortgages. Because what we want to do is we want to be able to just pick these mortgages, irrespective of the bank that is coming from, aggregate them, and sell on the debt capital market. I can go on, but let me stop there for now. So we've solved that problem of liquidity. We're addressing the legal framework. And maybe one thing I should talk about the legal one. In addition to that, we also brought in the foreclosure process. In Nigeria, when a bank gives out a loan and you want to foreclose on the house, it could take you 5 years, it could take you 10 years, And one of the things that does is that investors price that risk into the cost that they're giving you. But if there's that foreclosure law that the investor knows that I can recoup my investment on a timely basis, it also lends itself to a reduction in that credit spread that will be put on you. So we're addressing not just the supply side, but the demand side, and making sure that we get investors confident in bringing money into the market. So essentially, Nmrc was established to intermediate between the financial market and capital markets, and we're doing that. I'll stop there for now.
Thank you very much. I can see that Christian has joined us. Very nice to see you there, Christian. And we're just talking about, if you missed the beginning, the initial question about the origin story, how each of the mortgage refinancing companies came about. And Oscar, would you like to tell us about how Tmrc came to be?
Sure. Thank you, Kesia. And Thank you, members, for attending this important conference. The story is very similar because we play a similar role in our respective markets. So, Tanzania Mortgage Refinance Company started operations in 2011. Again, the purpose of starting the institution was primarily to assist with the mismatch with the banks, because banks have short-term deposits. When they issue mortgages, which are typically long-term in nature, they create mismatch, and we come in as a refinancing facility to bridge that gap. So that's the primary responsibility of a mortgage liquidity facility. But there are secondary responsibilities or secondary interventions that these facilities actually provide also. And I think my colleague mentioned a few. The first one is to standardize. When you move into refinancing and eventually you want to do securitization, you need to have standard mortgages. And I think this is almost like a global standard. Most mortgages are expected to have certain things that, you know, will qualify for a mortgage. So a title deed and things of that nature. So standardization is a secondary role that we play, because in order for a bank to refinance their mortgages, they have to meet those minimum standards. But the third role that we play, which is also a secondary role but very important, is that one of our ways of raising funds is through the capital markets, where we issue corporate bonds. So we do play a role of developing the capital markets in our respective markets by being essentially a corporate bond issuer on a regular basis. So we encourage others also to utilize the capital markets, and you can gain traction that way by having the capital markets that are a bit more active. We've done 3 issuances so far in Tanzania, and we've used those resources along with the loan from the IDA World Bank line to facilitate lending to the banks for purposes of mortgage lending. Let me stop there and I'll cover the rest when we proceed. Thank you.
Thanks so much. Johnson, let me ask Christian first, because in fact you're the newest and you've had the benefit of the lessons of all of the other institutions. So maybe we can ask Christian to offer his story, and then we'll come in with you. Sure. Christian, would you like to share with us how CRRH came to be? What are you trying to solve?
Thank you. Thank you, Kesia. Well, CRRH was created in 2010 as a result of the request of the government countries of West African Economic and Monetary Union countries of West Africa. I mean, Benin, Burkina, Côte d'Ivoire, Mali, Niger, Senegal, Togo, and Guinea-Bissau. The common point was that banks were not willing to finance housing, explaining that money from deposits cannot be used to provide long-term loan for housing. So government asked the regional institutions, the central bank, the development bank, BOAD, for instance, and also the commission, the political body, to team up to provide an answer for this situation. And it's at the outcome of our common reflections, the studies that CRH was created in 2010, and we started operating in 2012 for the benefit of the banking system of the 8-member countries union. From 2012 to 2018, we raised roughly $320 million in the local financial markets, mainly by issuing, not mainly, but exclusively by issuing long-term bonds long term, I mean from 10 years to 15 years, to collect long-term resources in the financial market that we lend to our shareholder banks based on the standardization of the mortgage that can be refinanced with us. We have done this with banks, but we also realized that it was not enough to help promoting affordable housing. So we started around 2016 to raise money from DFIs to refinance affordable housing too. And so far we have raised roughly $280 million of soft loans to the benefit of roughly 37 commercial banks in the union. Actually, we refinanced only our shareholder banks. So that's what I can say shortly, and just emphasizing that our new bond issue is we are preparing a new bond issue that we started with 29 shareholders, commercial shareholders banks, supported by the BOAD, the development bank of the union. Now we have 62 shareholders, as the development bank of the ECOWAS have joined us. Shelter Africa also joined us very quickly after inception. And since 2016, IFC have joined us too, as an institutional investor in our capital. And commercial banks join on a regular basis the team of our shareholder banks. So today we have 58 commercial shareholder banks covering roughly, I must say, practically 70% of the mortgage lending capabilities of the West African Economic and Monetary Union countries. Okay, I can stop there and provide more information if necessary. Thank you.
Thanks very much. Johnston, as you've just formed the Kmrc very recently, it's still fresh in your memory, and you had these other institutions ahead of you and lessons to be learned in a particular Kenyan context. How about the origin story for Kmrc, and is it different from your colleagues?
Thank you, Kezia. It's certainly not going to be different. In fact, we benefited significantly from the experiences from my colleagues here. Now, having been the most recent, and I think I'm also coming last for that reason, the Kenya Mortgage Refinance Company was established at the backdrop of a number of challenges in the Kenyan housing market. You know, high cost of land for development, high property prices, high incidental costs. We had challenges with registration processes and titling, as well as the lack of long-term affordable funding for the end user. Now, when you look at those challenges, particularly the one of lack of long-term finance that is affordable, that created the basis for the establishment of Kmrc. But the government of Kenya also wanted a policy tool, an instrument that can be used to drive reforms in the housing finance market. Now, in the establishment of Kmrc, the government and obviously the stakeholders made a couple of considerations. Number one is on the status of the housing market in Kenya. And to check on the status of the affordable housing in Kenya, a feasibility study was conducted. And the feasibility study informed the issues of demand, the issues of supply, and the challenges in the environment. Now, when you look at the supply, it became very apparent that there was actually a deficit of more than 2 million units in Kenya. And the deficit increases by about 200,000 units every year, with only about 50,000 units, that's what is indicated, that come to the market from time to time every year. And that is earmarked for high-income households for obvious reasons. Now, when you look at the status, we also had a number of challenges within the environment, some of which is what I have mentioned earlier, and a number of others, including, in fact, the approval processes, which take so long. On the demand side, the most apparent issue was on the lack of affordable long-term funding. Now, the other key consideration that was made, the number 2 consideration, in fact, was on the alignments with the government affordable housing agenda. The government of Kenya has 4 key agendas, and housing is one of them, under what they call the Big 4 agendas. Now, that arrangement created a useful alignment because the government then started doing a couple of things. The government laid out a strategy for affordable housing, which focused very much on low-income households, with income of 150,000 Kenya shillings and below, with homes of, unit prices of about 4 million shillings in Nairobi and Nairobi metropolitan area, and 3 million elsewhere. And that is a useful undertaking because essentially what we are saying is the government is supporting affordable housing because, of course, government is keen to help to achieve the social objective of providing decent homes to the people. Part of that also included government providing incentives for development, reducing development costs, for example, was one of the incentives that was provided to developers who are developing at least 100 units a year, and that's a tax benefit, which reduced from 30% corporate tax to 15%, as long as you can demonstrate construction of at least 100,000 units. There are a number of other interventions that have come in the process, including, in fact, the review of policies and laws within the built environment, some of which are still actually ongoing. But a number of them that created rigidities or actually continue to create rigidities in the market, making it difficult to achieve affordable housing, have been continuously under review. The other key consideration, this is the last one, is about the institutional arrangements. Now, there were conversations around what is the nature of institution that is actually needed to drive this. And this created some discussion on there are existing institutions currently, like for example, we have the National Housing Corporation in Kenya and a number of other institutions that do housing. Will it be better if you have an existing institution redefined to run with this kind of objective? So that's one of the issues that came in that conversation. The other key one was what is the nature of the institution that we need to establish? For example, do you need a fully government-owned entity or you need something in between, like a private-public partnership? And with all that conversation, Kmrc was established as a PPP. And the main reason was to crowd in private sector funding to support affordable housing. Now, that also then led to conversations around what are the kind of institutions that need to come in as part of this agenda, as part of Kmrc. And we went to the market, obviously, to the natural institutions that ordinarily come in, like my colleagues have mentioned, are banks. And banks, for the longest time, have been doing mortgages. But there was a slight variation that we did in Kenya. We observed that SACCOs in Kenya play a significant role. They lend mainly personal loans, but a lot of that personal loans actually go into incremental housing development. So it was felt that SACCOs will actually be needed in that equation, and SACCOs were actually brought in. So we went out, brought in all the banks that do mortgages in the country, and at least 25 SACCOs that also do lending and have obviously a significant impact on creating affordable financing to the people. And we ended up onboarding 20 financial institutions, that is 9 banks and 11 circles. Of course, we have a number of other institutions that are part of Kmrc, not least Shelter Afrique, which is here, IFC, the government of Kenya, and others. But more fundamentally, the onboarding of the primary mortgage lenders, the institutions that lend normally for mortgages, was based on the consideration that they need to be prudentially regulated. And the intention is to de-risk the institution very significantly, because they have the interest of that institution when they come in. So those were the key. And then, of course, the institution development started once we onboarded the primary lenders, which are certainly needed for the business to move. The other key issues were then around regulations, which, of course, the regulator had to come in, primarily to prepare the regulations that are required for oversight of the institution, and the developments of policies, procedures, etc. within the institution. So that's the journey we took, and we had finalized that. I think it started in 2018. That's when Kmrc was registered. The whole process actually started in 2017, when the President of Kenya made a pronouncement about affordable housing being part of the agenda, and everything now started rolling. In 2018 is when Kmrc was incorporated. In 2019 is when the institution was launched, got a license in 2020, started lending immediately that year, at the end of that year. And, the process, we are not yet there, but we have made, I think, important steps for the business to peak. Thank you.
Thank you very much. I'm quite sure that there are a lot of questions in the audience, so I'd love you to think about that. I have one more question I'd like to ask all of you before we open up to questions from the audience. What I've heard quite clearly from all 4 of you is that what the MRC does is it champions mortgage market development broadly. And in doing that, it's more than a liquidity facility, but it creates the environment in which that liquidity is needed, wanted, required. And that when you standardize, as you said, Oscar, that then creates an investable opportunity for a whole range of investors who haven't thought about this before, possibly, who start to move in, and then the way in which you've been engaging in the capital markets. So you're crowding in new capital into the market who are recognizing this as an opportunity. And then once that happens, that increase in capital, it addresses your mismatch. And what it also does is it reduces the cost of capital because you have greater confidence of the health of the sector. And in that sense, the mortgage refinance company becomes the champion for the government policy for driving a sound mortgage market growth. Very, very exciting. So what I'd love for you each to quickly reflect on, and Christian, if I can start with you, is what would you say the impact has been of the CRRH on financial inclusion and financial access in housing within the region? The 58 member banks that you've talked about, are they lending at levels now that they wouldn't have been able to before? Can you quantify the difference, the impact that's happened around financial access? It looks like Christian has frozen. Yeah. Okay, so we'll wait with that and move on. Perhaps then.
Yes, thank you.
Okay.
Thank you, Kisha.
Oh, he's back. He's back. Excellent.
Okay, we made an impact study last year. We ordered that study, and one of the main findings is that a large number of those banks were not able to offer mortgages in 2012. So the first impact is that we made mortgages available for a large number of people. And by extending maturities at competitive cost, we also help to increase the survivability of a large number of households so that they can afford housing too. And I can also add that if you look at those banks, given that we are offering today some concessional loans to refinance affordable housing, they are more eager to offer those type of loans to their customers, and we also supplement the refinancing with technical assistance facilities based on facilities we raised from the World Bank, so that we can help those banks defining all of the environmental and social requirements that is needed to extend safe mortgages to the customers, avoiding to lend money to people in areas that are not very suitable for construction. For instance, we made a study for the 8 countries, and now we provide technical assistance to those banks so that they have ENS requirements in the mortgage business in the 8 countries. And there are also a number of impacts we had, because for instance, 2 years ago, we organized a special conference on housing and the impact of housing on economic growth, where at least 4 ministers in charge of housing and finance from the 8 countries attended. And we tried to establish for them that housing financing is not a social policy, but it's a major component of economic policy, given the large impact housing finance can have on the economic growth. So those are a number of aspects I can stress for you.
You also mentioned something similar in the sense of on the origination side.
Yes, I did, but much more importantly, before the advent of Nmrc in Nigeria, the spread between government yield, which is how much government issues, and what mortgage rates were, was about 10%. So if government borrowing was at 12%, you get mortgage rates at about 22%. With the coming in to being of Nmrc, we have been able to narrow that significantly. So it's now about 5%. We want it to come down because we believe it should be a volume game. But because now everybody in that sector has access to liquidity from Nmrc, there's now that competition, which is shrinking that spread that they will normally have charged. But with all of this that we are doing, we also realize that a large segment of the market is still not being captured because of equity down payment. You know, for you to come up with 20% that is required, it's a tall order. In fact, a study was done in the US that it takes about 7 years, even in the US, to get that equity. So we are coming up with a product which is called the mortgage insurance or mortgage guarantee product, so that people with 5% equity can come in, get an insurance, and get onto that ladder. Because with the capital appreciation that comes into it and all of that, you really get a lot of mileage when you go into mortgage. So in addition to seeing a significant reduction in mortgage rates in Nigeria, we've elongated the tenure, as I said. We're also now bringing in products that will bring in a lot more people into that, to the mortgage market. And hopefully all this translates to tax revenue even for the government, because the more people are into mortgage, they pay their insurance, they pay their taxes. A lot of other ancillary services come into being. So Nigeria now has a very thriving and effective credit rating agencies or credit bureaus, where Profiling has now become easy. People have credit scores. We have about 3 of them and things like that. So a lot of things will also be spun out of this. Let me stop there for now.
It's like dropping a pebble into the pool and the ripples just carry on.
Yeah.
Oscar, what would you say has been the impact on the Tanzanian economy?
I think the impact has been significant. Let me start with the institution first. I mean, we've built an institution today as Tmrc, which started off with only 4 shareholders and really nothing in terms of the market and the system. Today, as we sit, we have 17 shareholders, including Shelter Afrique. So Andrew is not only my AUHF chair, but he's also my director at the board at the Tmrc. But we also have the IFC and others. So the institution has actually progressed, and because of that, it has created a significant confidence in the market. So we've been keeping data since we started. There were 3 institutions, 3 banks that were offering mortgage loans back in 2011. But as we speak today, we have 32 banks. Out of 50 banks that are in Tanzania, 32 are offering this product. So you can see that the landscape has really expanded in terms of institutions that offer the product. But also the tenures, which is really the main part of mortgage liquidity facilities to extend the tenures. Our tenures before our existence were 5 to 7 years, which is not a mortgage. But since then, if you look at the profile of these 32 banks that are offering the product today, they offer 15, 20 years, and the regulations in Tanzania allow up to 25 years. So in terms of extending the tenure and improve affordability because of the reduction of monthly obligations, I think we've done a good job in terms of that. The other aspect is because there is competition. Instead of 3 banks, there's 32 banks that customers can choose from, consumers can choose from. Naturally, the prices or the interest rates have gone down a bit. So we used to see rates that were north of 20%, so 22, 25%. But today, the rates range between 15 to 18%. Still high, but low comparison compared to what they used to be. And then in terms of the overall market intervention, as Kesia, you mentioned, beyond what we do in terms of our role, we also participate in arranging workshops where we bring in the stakeholders in the housing sector so that we can discuss common challenges and try to forge way forwards that we can work together. We participate in training, and we do this with institutions that provide training, but we also have tailor-made mortgage trainings. My colleague, Oswald Urasa, is there. He's one of the certified trainers who does the trainings with the different institutions in Tanzania. So we do those type of intervention to try to also uplift the market and provide public awareness to also the general public so that they're aware that this product is there and that it is available for Tanzanians to take advantage of. Thanks.
Thank you. Johnston, in your short lifespan, your impact on the Kenyan economy?
There is, I think, tremendous impact already we begin to see. I don't want to repeat what my colleagues have said because it's actually applicable to our case. But when you look at our market at the moment, and I think as Kesia indicated earlier, when you have available cheap funding, end user finance, it actually stimulates that supply. And of course, what you expect is that developments, constructions, and if you come to Nairobi today, there's a lot of construction going on, not just a road, and that makes it difficult for you to come out of the airport. But there is also a lot of developments that are currently going on. It's a major construction site. Now, what that means is that, of course, constructions and that kind of supply, you have a number of externalities that follow that. And those obviously include job creations and things like that. Now, we have also beginning to see a shift in the institutions that provide mortgages in Kenya. The traditional institutions that do mortgages are banks, but now we have additional institutions that are doing that, which creates significant diversity. And we have already begun to see the number of mortgages moving up in Kenya. For the longest time, they have been ranging between 25 and 26,000 mortgages. By the end of last year, we were seeing an upward trend on that, and we believe that's going to increase even further. Now, the other key economic issues that are coming out of there is that this housing business actually creates efficiency, because you now see for the first time a number of changes that are taking place within the laws, which creates efficiency essentially, and making access for decent housing more for the people. Now, one of the other key things, and this sounds theoretical, is that when you provide liquidity to the financial system, it actually creates stability. And this is particularly important for the central banks. Now, that liquidity extension actually creates additional resources for the banks, because you're providing liquidity to the banks, and that obviously paves way for additional resources to be shifted to other areas. And what that does is that it helps the financial system to scale up the offer of mortgages, like what we are beginning to see in Kenya, by the number of institutions that are accessing or they're actually providing mortgages at the moment. In fact, in reaction to that, recently, the Central Bank of Kenya reviewed the risk weights for residential mortgages in Kenya, which became effective on 1st July 2021. And that reduced from 50% to 35%, based on the recognition that there are a number of efficiencies being created in the system, and that you're providing mortgages that are extremely secure, and that also actually aligns with Basel III requirements. And that, when you look at the pronouncement that the central bank did, it talks a lot about Kmrc and what Kmrc does and how the central bank is seeing that as an instrument that is creating significant reforms. So that alone actually releases a lot of resources for the banks and other financial institutions to increase their offer for mortgages and others. There are certain institutions, when you release those resources, they'll potentially put into mortgages, but they could also lend into other sectors of the economy.
Thank you very much, yes. Are there any questions in the audience? I know that we're right before lunchtime, but I see there's one. Charles? And you also, okay, you'll be second, sir.
Thank you very much for insights shared across different countries. We are so glad to learn from you, as looking forward to having same institution in this country. I have one question around mentioned ABS.
Can you introduce yourself, please?
Yes, I'm Jean Bosco Yachu. I'm from Access to Finance Rwanda. One of you mentioned about asset-based securitization, and I wanted to understand among you who has already sourced funding or introduced mortgage-backed securitization to really unlock more liquidity to the market, but also stimulate the capital market activity. If not yet, what are the challenges, or why not? I know what happened back in 2008 in the US, but I still believe that MBS would be a very good instrument in the African context to stimulate more a kind of supply of housing in the African context. Thank you very much.
Let me take one more question and then we'll...
Half of my question already he asked, but the next half is this mortgage-backed security. When you are refinancing the secondary mortgage market, and this is for Christian, can you reduce the tickets to a figures, fraction it, the MBSs, to level that the crowd and the local people can invest, choosing the different maturity they need to adapt it to their investment. So we don't go to other foreign institutions, we can fund from the local market.
Sorry, Kesha. Can we take one more here?
One more, okay. Yes, sir.
Thank you so much. My name is Emmanuel, and I work for the Development Bank of Rwanda. I have one question related to the impact that you already, thanks for sharing. But if Kmrcs are playing the secondary, in the secondary market, secondary to the primary lenders of mortgage, and by acquiring all those sources from different shareholders, I want to use maybe just a particular example from Nmrc, where you mentioned that originally these financial institutions would maybe get financing at, for instance, 10%, and you find that the final beneficiaries, they will borrow at about 22%. Now, they can access at 5%, and then you didn't tell us maybe now what could be the interest rate, and my question would be, what is the role or what Kmrcs are doing in influencing, directly influencing the final borrowing interest rate, whether it is capped from the funds you give them, or whether you leave the financial institutions to play around with the figures depending on the demand. Thank you.
Kehinde, do you want to start?
Yeah, those are very good questions. The first one was on ABS and MBS. As you know, MBS is a subset of ABS. So you can have credit card securitization, you can have auto securitization, you can have mortgage securitization, and then you can go into CDOs and all of that. So this is a progression. The way it works is that most liquidity facility, and we take our cue from the most successful one in the world, from the third world, which is Chagamas. You always start as a liquidity facility, make sure you have everything in place, and then you get to that place that you start securitization. So Nmrc is in that process. We have 3 phases. The first phase is to standardize. The other phase is to make sure you have all the regulatory approvals in process, and then you can start securitization. People have a misconception about what happened in the US. And I used to work for Fannie Mae in the US, so I worked with Fannie Mae for 10 years. It wasn't a question of the product that was bad. MBS, ABS, those are nice products. It was the underwriting standards that were bad. So you had what we call ninja loans, no income, no jobs, but they still gave you loans. So it wasn't the MBSs or the ABSs that were bad, well, because people didn't follow the underwriting standards correctly. And that wasn't even just, it was also a push on the part of the government. They wanted to get more blacks and minorities into homes. So government through the family, FHFA now, our regulator at Fannie Mae and Freddie Mac, reduce the standards. So that is what we have all ensured as Underwriting started. We're ensuring that mortgages are now being originated as standards that ensure that these are conforming mortgages with good credit rating. So we have solved that problem. The next stage is, you now need to have data, as I said, do you want to originate a mortgage-backed security, and then you have to do it to tranches, So in Nigeria, when we came in, we didn't have an understanding of what is the weighted average life of a typical mortgage. You can't issue an MBS if you don't even know that, because you want to know that. So we have spent the last 5 years getting data on how we are now going to securitize these instruments. And we're working through the regulatory approval now. So you want to get an MBS and say, okay, this is tranche A, you have the junior tranche, you have the mezzanine, you have the senior tranche, and then you want to pass it into interest only or principal only and all of that to meet the various demands of the investors. So my simple answer to your question is that we're almost there now, but we needed to get a few things in place before we get there. But there's nothing wrong with those instruments because they cater for different kind of people. And then the other question was, when I said when we came in, the spread was about 10%. Now it's about 5%, you know, within what we get. So Nigeria is a very, the interest rate is, the volatility is very high. So when we issued our first bond about 5 years ago, we issued at 14.5%. The last bond I issued in October last year was at 7.2. So you have that volatility. So the interest rate in Nigeria can move 400, 500 basis points. But at whatever cost that we issue now, the general pricing of the banks is that it's not more than 5%. So our last instrument was 7.2, so they are giving out at 12, you know. So that's the way it works. We have deliberately not insisted on a cap because we believe that markets will determine that. If I'm more efficient than you are, and that's what it should be, if I know that I need to provide this service and at a cheaper cost than you, I'll snatch your customer. We want to build that thing. But by the time you cap it and all of that, you build efficiencies into the system. So the way we are doing it is on our website, we publish the rates of mortgage banks. So we say, okay, this mortgage bank's rate is 18, this one is 16. We leave that to you to do, you know. So by the time I realize that I'm doing 18, but I'm losing customers, the guy at 16 is picking up my lunch, then I'll change. So we believe that it should be market forces that will drive that. And that is what is sustainable on the long run. Any cap that you do now might have short-term impact, short-term benefit, but it's not sustainable. I'll stop there.
You make such an important point about market transparency, so that consumers and investors can all make their decisions on the basis of the information in front of them. Oscar or Johnston, would either of you like to add anything to that in response to the questions?
I think my colleague did a good job explaining it, but I'll just add one thing on this securitization. I think it's important for people to understand you cannot get to that stage with very small mortgage markets. So we need to build a primary mortgage market so that we have a lot of mortgages that you can package then and do the ABS, MBS. So I think we're in that continuum. So we're refinancing, but the continuum is as you progresses and the market grows, you get to the level where you can do the ABS and MBSs. And I believe one day we'll get there. And I think that's the only thing I would like to add based on what was explained here. Thank you.
Thanks so much. Johnston.
Thank you, Kezia. On that, we have an asset-backed security law in Kenya. What we are waiting to do is bring that subset that my brother Kehinde has talked about of mortgage-backed securities. But of course, that has to be achieved over time. You know, we need standardization. We need common terms for you to be able, in fact, to even structure an MBS. So we haven't gotten there yet, but we, just like Oscar said, we are likely to get there at some stage. When you talk about the question about accessing funding and how much it is that you're lending at, from our experience in Kenya, what we have essentially already started creating some impact. We are now actually providing single-digit mortgages, which is something that has been unavailable for the longest time. Institutions that have accessed Kmrc refinancing are actually now doing single-digit mortgages, which is around 9%. But Kmrc is lending at about 5%. Our spread is very minimal from the cost of funds, extremely minimal. But that was also made intentionally, so that then we grow the market slowly.
Thank you. Is Christian still with us?
Yes, I'm here.
I think I'm going to round us to a close now because I'm sure you're all famished. But this has been such a good discussion. Thank you very much. And thank you to all of you for staying with us. I am quite sure that our colleagues will be available for conversation and for more detailed discussion. It really is an important issue I know that Rwanda is considering right now. And there is this experience across the continent, and many of the leaders who are driving that experience are right here in Kigali this week. So please make use of that.